Well, there's tremendous change on the way, and we know it. We're seeing it in our lives. The ground is shifting underneath us. And it is because of these innovation platforms. The most important thing is to get and stay on the right side of change. Now, what does that mean in terms of portfolio construction? Do you want to go 100% into a strategy like ours? Well, most, given the volatility, cannot do that. Volatility is not always a bad word. In fact, in a bull market, volatility is your friend. Certainly that was the case for us in 2020. The reason it has become a bad word is since the tech and telecom bust, we have seen every bear market accompanied by an increase in volatility as measured by the CBOE's VIX. And yet, because so many people in the business joined after the tech and telecom bubble, they do not remember that we have seen volatility move up in up markets for extended periods of time. And I think we will go back there again. I think 2020 was a glimpse at that. And we use the volatility to our advantage. We know that disruptive innovation is controversial, and with controversy can come volatility. We believe that our research points us in the right direction. And so if a stock is down 10 or 20% in the short term because of some earnings result where a company decided to invest more to innovate, and was punished, we will be buying a stock like that. So we use the volatility to our advantage. And very often you will see that trading around volatility adds significant alpha. In 2018, when the market was down, our trading around Tesla alone, now granted, it was one of the more volatile ones, our trading around the volatility of Tesla alone added, I believe, 175 basis points to performance in a down year. That had nothing to do with how Tesla did. That was simply our trading. So we do use it. I believe we've used it massively in this last year. And the proof will be in the next few years. Well, we'll see if this leaning into the negative sentiment and declining prices is going to pay off. It has every other time in my career. The most important thing is to get and stay on the right side of change. Now, what does that mean in terms of portfolio construction? Do you want to go 100% into a strategy like ours? Well, most, given the volatility, cannot do that. I might do that personally, and I have a majority of my financial wealth in our strategies. And that's because of the conviction I have in them on a 5-year basis. But just let's take the more risk-averse investor. If we're right, and there's going to be a lot of creative destruction out there, there are going to be a lot more IBMs and GEs. Again, they were never supposed to have failed as spectacularly as they have in terms of their promise. If we're right, then even the conservative investors need a hedge against that possibility. Our portfolios are a great hedge, and we have a white paper on our site about how adding our portfolio to traditional growth and value portfolios, 5 to 10%, I think, would have increased returns, and relative to just the plain vanilla value growth, would have increased returns and lowered volatility, because the correlation of our returns, and you can see it in the last couple of years, the correlation of our returns to the traditional benchmarks has been very low. Last year it was negative. The year before it was positive, but over time, very low correlation of returns. And so we know that most of our clients that are advised by RIAs have exposure in, I think it's below 10%, and I think most below 5%. I certainly would be using this downdraft to increase that allocation, because if anything, during the last year, and it is quite a year for me to be saying this, if anything, our conviction in how rapidly the world is going to change and how transformative these technologies will be as they converge and feed one another, our conviction in that outlook has increased dramatically. Well, I think I think because of the year that we've had, we've probably packed in a lot more substance. You're going to learn a lot more about NFTs and the metaverse. We think that word's becoming overused now, and in the continuum of Bitcoin, DeFi, and NFTs, we're going to help put that into perspective. And I think that's probably the question we are getting the most. People know that we're all about innovation. They want to understand if we really believe in this NFT thing, and we really believe in it. So we'll look forward to sharing all of that with advisors and with the world. Well, and I will hearken back to 0809. How many people do both of us know who just couldn't take it anymore, and they became very emotional. Their life was flashing before their eyes. They thought they were going to be destitute. You conjure up all kinds of fears as downward momentum continues relentlessly day by day. And they finally can't take it. They sell, and they regret it for the rest of their lives. They think about it every day the market goes up after that. And so I would agree with you. An emotional response, just avoid it. It is usually catastrophic to long-term performance. What is additive and significantly so to performance is averaging down. It doesn't feel good maybe as you're doing it, but you would be shocked how little it takes if you're consistent and you just keep averaging down.